Hi, and thank you for watching. My name is Mike Mills, and I'm one of the partners here at the Legacy Advisor Group. I'm recording this the morning of Friday, April the 4th. Each quarter, we like to put together our thoughts on the market and economics and hopefully provide a bit more clarity. As you've undoubtedly heard me say before, we are long-term investors at the Legacy Advisor Group. This is important to remember, as over this past quarter, some days have felt like weeks and weeks like days when you watch what is transpiring in the stock market and economic news. At the end of today's talk, I will briefly comment on the tariffs. There have been no shortage of geopolitical news in the media over the last quarter, each news morsel pulling on emotional strings of investors and the market. As much as we all like our favorite analysts and commentators on various news outlets, it's important to remember that many are focused on short-term volatility and activity and ultimately gaining your viewership. We pay attention to the news, meet with money managers, and read many different commentaries weekly. None so far have changed our opinion that being a long-term investor with a plan is the right strategy. It's always important to remember that volatility is normal. I recently sent a short video with this chart from JP Morgan highlighting the intra-year declines. The S&P 500, often referred to as the market, is off over 10% from its highs as of April 2nd, technically reaching a correction. Most Mag 7 names are in bear market territory, off over 20% from their highs. As you will see, historically, declines happen annually. The average inter-year decline is negative 14.1%. Imagine if you sold every time the market went down or rushed in as the market was hitting highs. The discipline of being a long-term investor avoids both. This next chart from JP Morgan on consumer confidence shows the results of staying invested when confidence hits lows. Early in my career, I worked with Franklin Templeton, where Sir John Templeton often reminded us that the time of maximum pessimism is the best time to buy. We've all heard Warren Buffett say, "Be fearful when others are greedy and greedy when others are fearful." We agree with both of these great investors. However, while saying this, I remind you that we are not attempting to time the market. Rather, we are believers of time in the market. This is why deploying a dollar cost averaging strategy with new or monthly cash tends to work well when investing. Diversification is also key. This next chart from JP Morgan is often referred to as a quilt chart, highlighting the importance of diversification. While many have been underweight international investments over the past decade, represented here as DM and EM equity on this chart, we have maintained an allocation of between 10 and 20% in most portfolios. Year to date through today, international and fixed income has provided ballast to public market portfolios. Diversification outside of public markets is also key. Recently, one of my partners and I were at an investment meeting with other wealth managers where only 3% of the room uses alternatives or private markets to diversify. We have and will continue to, when possible, maintain an allocation to alternatives such as private equity, private real estate, and private debt. The low correlation of these assets have to public markets is key, particularly during rough patches in the public markets. Other asset classes, including preferreds and infrastructure, may be used for further diversification. What about fixed income? The 10-year Treasury, after popping late last summer, has settled down this past quarter, down now over 60 basis points from the beginning of the quarter. With this, you've seen prices move up, and we're seeing that bonds are not as correlated to stocks like they were during 2022, when both were down. Not to try to say the 60-40 is the end-all be-all for everyone, but bonds are starting to do their job of balancing a portfolio when stocks are volatile. I will add here, with the rapid drop in rates after the tariff announcement, the bond market is pricing in a higher possibility of a recession. Finally, let's talk about consumption. After all, when referring to tariffs, consumption is likely to be impacted and has been impacted by inflation over the last few years. Nearly 70% of U.S. GDP is made up of personal consumption. So far, the consumer is somewhat stable, with most spending still occurring in the services sector, things like healthcare, hospitality, and transportation. What we've also seen is that the consumer savings rate is at 4.2% now. After COVID, savings dropped as consumers were spending at one of the largest rates historically. However, savings is down from historical averages of 8.4%. I bring these up because these are two we want to watch. If spending goes down, you typically get an increase in savings, meaning the consumer is worried. This is something we're starting to see now, and that correlates with the confidence chart. Nothing alarming, but worth us watching and worth noting the maximum pessimism point I noted earlier. One additional note that is not on this slide, the labor market, continues to hold up well. We got a great positive print this morning. This is a positive. We really cannot talk about consumption without talking about consumer sentiment, though. With so much of our GDP made up of consumption and how people feel to consume, sentiment is starting to lower much like it has in past pullbacks in the market. Anytime there's a bump in the market, you have a choice to make. Do you sell and make that pit in your stomach go away? Or choose to stay invested as the market has seen many bumps throughout history and will get through this one as well. Often the sell and sit on the sidelines has resulted in missing the recovery in the market. This itself has often led to more emotional and monetary cost. Finally, let's talk a little bit about tariffs. I don't know about you, but I've read more about tariffs in the last few months than I ever thought I would. There's a lot we can get into here regarding tariffs, but in the essence of time and possibly seeming one-sided, I will not get into details during this call. As of April 2nd, President Trump's tariff decision is out, and whether you agree or disagree with the tariffs, one thing is true: this is likely not over. The market responded negatively, as many expected. We've said before that the market likes certainty and clarity, both of which continue to be non-existent. Some are calling for tariffs to be short-term inflationary and possibly become deflationary. Others have said recession probabilities are higher. We don't know what the long-term effects will be, but what we do know is that this has thrown a monkey wrench in what seemed to be a pretty smooth global supply chain. We do know that the tariff talk has contributed and continues to contribute to short-term volatility. What we also know is that if we look historically over 100 years, despite what geopolitical events and non-geopolitical events have occurred, bear markets and bull markets, recessions and booming markets, it has been prudent to remain long-term focused. That is our promise to you. We will always remain long-term focused on you and your family's goals. If we can answer any questions, please do not hesitate to contact us. And on behalf of my partners and team here at the Legacy Advisor Group, thank you for your trust.